So as we step into the final quarter of 2024, there's a lot to unpack in the markets. We've got Fed decisions, election jitters, and ongoing volatility. There's plenty of action that can and probably will impact your portfolio. But here's the good news. Despite some of the recent turbulence that we've seen in the markets, fundamentals still remain strong. So what we're going to do in this video is dive into a review of the last quarter and our outlook for the rest of the year. Let's get into it. So last quarter was a wild ride, to say the least. Markets swung back and forth between really good news and really bad news. Yet in the end, stocks came out on top. So what happened during the quarter is we saw higher than expected unemployment numbers followed by rough payroll revisions that really shook things up. And for those of you following things closely, you might remember the yen carry trade unwind. That essentially spiked the stock market's fear gauge, or the VIX index, to new 2024 highs. But then came the pivot after the Fed Chair Jerome Powell came out and signaled that, quote, it's time to cut rates. We saw a rally in bonds and the dollar took a dive. So as a result, U.S. stocks in the long end of the yield curve ripped up higher. Now I want to talk a little bit about our investment approach. And while obviously individual client results are going to vary, we broadly bet on stocks over bonds last quarter, and we leaned towards U.S. markets with a specific focus on companies with strong balance sheets. Those moves drove most of our active returns last quarter. On the fixed income side, our call to favor longer duration or longer term treasuries and mortgage-backed securities worked out well for us. But as the trends that powered our wins last quarter start to cool off, we're making some adjustments. So pulling back on the equity overweight, more of a strategic move to help us navigate the choppy waters that often come with election season. And even though we've dialed back a bit, we're still in the game. So I remain cautiously optimistic with relatively low recession risks on the horizon at this point. So with that being said, our preference for stocks over bonds still remains, just at a slightly lighter level. And the idea behind that is it's keeping us flexible for any opportunities that might pop up as we head into the end of the year here. So the big question, what's in store for the rest of the year? As many of you know, the Fed kicked off its easing cycle with a 50 basis point or a 0.5% cut back in September. And essentially they emphasized the strength of the economy and their aim to maintain that strength. So really with inflation easing, they're recalibrating to a more, I would say, neutral stance. And what the market's pricing in is another 1.5% cuts by the end of 2026. So essentially, unemployment has risen just enough to justify these cuts, though I don't necessarily think at the current levels it signals a recession. So what does history tell us? Speaking specifically of recessions, I was curious, how have stocks and bonds fared historically when the Fed starts cutting rates? Well, whether we get a recession or not, bonds tend to perform well as rates drop. Why is this? Because of that inverse relationship between interest rates and bond prices, right? When rates go down, bond prices go up. And it's not just bonds. Historically speaking, specifically stocks, bonds, and even alternatives have all done well in very similar scenarios. Now let's shift gears here a little bit. I want to talk about volatility. Markets pulled back last quarter between essentially mid-July and early August, hitting that peak sell-off back on August 5th. Tech stocks led the charge there, dropping nearly 15% before bouncing back, as you can see on the chart here. But during those dips, bonds provided a steadying hand, which is the reason we want to have that allocation in place, in the first place. Market ups and downs, yep, they can surely be nerve-wracking, but remember, fundamentals always win in the end. So sometimes it just takes a little bit of patience, and that's why I believe knowing what you own and why you own it can make all the difference when the market's starting to feel jumpy. So with Q4 here, there's plenty of things that could shake up markets, but volatility isn't all bad. It's not just about the dips, but it's about the recoveries too. So I wanted to give you guys an interesting stat here. So since 1989, despite 20 dips of 10% or more, which is the definition of a market correction, the S&P 500 has averaged still through all of those 20 pullbacks 11% return per year. So those big drops aren't just the end of the road. Really, they're a part of the journey. So looking ahead here, as the markets start to shift into this Fed easing cycle, and as we analyze essentially economic data for signs of slowing growth, we'll definitely keep an eye on the impact of the US elections here this fall, with surely is going to add more volatility. Closer to the election, I'm going to be sending out another video dedicated specifically to markets and election cycles. So be sure to keep an eye out for that. That said, as we wrap up a wild summer for financial markets here, now's a great time to revisit your portfolios and ensure that you're comfortable with your allocations going forward.